Oh, okay. So you traveled a good amount.
Quite a
Uh,
bit. Yeah, yeah.
all right, awesome. I just got back from Chicago myself last night, and so I'm not on my normal computer, so I'm trying
Oh,
to get everything adjusted right so I can see everything. Uh, hey Steve, how's it going? I'm just gonna wait for Chris here, but I'm excited to see what you got. I did take a little bit of peek at what you're doing, and I always love it when people take a broader view. That's how I was trained. So always take that broader view first, and then narrow in. And so it looks like that's exactly what you're doing. So I can't wait to see uh, all the details.
yeah. It's really exciting to be able to have everything come together and share with folks what I've learned over the last 30 years. So.
Yeah, awesome. Do you have? I forgot your background. You want maybe just remind everyone what your
Yeah.
background is?
Well, I mean, it's the abbreviated version is I started in investment banking and found my way to graduate school and then back to banking and stumbled somehow into investment newsletter money management business back in the late 1990s and
Okay.
fell in love with it and been doing it ever since.
Oh, nice, nice. All right.
Yeah.
Cool. Let's see. Chris should be here. Normally, uh,
Terry says he's also in Tucson, and I may be hiking in Sabino this afternoon, Terry.
maybe you'll run into him on a trail.
There we go.
What do you think of today's market? Were you had a little sell-off recovery? Were you surprised?
Yeah, it's again, I really have honed in on what we're doing here with the opening bell arbitrage and using these eight macro indicators to compile a forecast, and the forecast today was for the S&P to be up 25 bips, and
Okay.
we've been trading right around that. So I can't explain it other than it's pretty darn amazing to watch this forecast tool deliver the goods day in and day out.
Awesome. Hey, Chris, how's it going?
What's up, guys? Happy Monday.
Happy Monday.
JD, nice to see you, man.
Yeah, hi Chris, how are you?
I'm doing well. Nice little background you got going on. What's the
Yeah,
deal?
I'm
Working
down
outside
visiting
today?
I'm at my mother's place in Arizona, Tucson.
Okay,
So
very cool.
yeah, it's beautiful here.
Very nice. How's everything going, man? It's nice to see you. I know we did some work, seems like forever ago, but it wasn't that long ago. How's
Yeah,
the trading? How's the year?
I'm in
How's
the
it been treating
bunker.
you?
Yeah, yeah,
In the
I'm in
bunker, yeah.
the the Prosperity Pub is awesome. You guys, it's really been a fast and furious experience for me, and just really working hard at bringing everything that I try to do into products that folks can use on a regular basis.
Yeah. Do you have anything that you'd like to show us today? Anything you want to
I
give us a
don't,
sneak peek?
other than I think the teas, and let me just put it in is linking to the Telegram channel where right now, because I'm so new, we're just giving it's chock full of a lot of great ideas, and everything is gratis right now. So
Okay.
um, let me put that link in here
Okay. Yeah,
if
feel
I
free
can
to share that to
figure it
everybody.
out.
Yeah, it looks like Dion already threw it up there.
There it is.
And so I'm on here too. I'm
Double the
taking
fun.
looking at it. I'm looking at your market scorecard here for today, for this morning, and volatility low. So tell us a little bit about what these dials mean. Like, was it
Yeah,
when
let
it's
me
low or high
I
or
tell you what I can do is pull up uh, let me pull up the if I can find it here. I am going to pull up the market scorecard so everybody can see what we're talking about.
Mhm.
And this is something I produce every day. Okay, let's see.
My favorite is the news is neutral because we have none of it coming in.
Well, that's a great observation. I'm glad you point that out because uh, really with this government shutdown, like a lot of folks, I'm flying in the dark.
Sure.
And let me share my screen here, and then there is that showing up.
It was just a second ago. It for some reason got
Yeah,
blurry. It's like a black shade right now. But
Okay,
there you
they
go.
can,
There we go.
yeah.
Now we can see Telegram.
okay. Now
Can you
that
click on the image and see if it'll just show like that
that's what I
screen?
did, and it went to black screen. So let me try
Okay.
something else
All right.
here.
Otherwise, I've got it pulled up in mine, but try one more time, JD.
Okay. Let's see here. I'm going to pull up the master, which hasn't doesn't reflect today's dial inputs. Okay, let's see here. How about that?
Perfect.
Yep.
Yeah, so this is the scorecard, and really what I try to do 30 minutes before the market opens, folks, is take a look at all of these variables and assign based on what the data is telling me. I mean, just simply put, it really is red for bad and yellow for neutral and green for good. And after I input all of the dials, what comes out of it is a forecast for my expectations, uh, really what's going to transpire in that market day. And the trading then use of the scorecard is comparing what the forecast is to where the markets, where futures are trading right up until the open. And if there's a deviation between my forecast and futures, that's where I structure a trade that we can do an intraday call or put spread on whatever index shows the most potential from an arbitrage perspective.
Are you doing a lot of 0 day trading right now, JD?
It's all, it's funny you say that. So today is the first day where we used a Friday expiration trade.
Okay.
The reading of the scorecard was a little bit tricky today. This can happen. We talked about the economic news being a zero, um, mainly because of a lack of data. But 30 minutes after the market opened today, we did get ISM manufacturing data.
Hmm.
And so the scorecard reading this morning before the market opened was a little bit incomplete. And because of that, the arbitrage that I identified this morning was crypto. Somebody asked about crypto in the chat I saw, and I use crypto as more of an indicator on market direction than anything else. And the last several trading sessions, it's been really interesting because Bitcoin in particular has been a very, very strong leading indicator. But in the last week or two, it's been surrendering that strength in its leadership position.
Hmm.
So today you had right before the open, you had the S&P, I think was trading close to 50 bips to the upside, and Bitcoin was down significantly. I think it was down 2.5 to 3%. Um, and so that to me was an arbitrage that if Bitcoin uh, retains its leadership position, there's an opportunity on the upside. And the Bitcoin ETF doesn't trade 0 day, so we use the
Right.
Friday expiration on that.
Okay. Um, I'm just curious. So using Bitcoin as kind of a barometer day to day, what about like mags as like what's kind of your risk on risk off day wise? Like, do you think that Mag 7 matters just because of the concentration we see? Example being last week. I mean, market breadth, in my opinion, was a huge divergence last week where we had
Yep.
a couple of days we saw 60+% of stocks declining, but Nvidia was up pretty large. I mean, we had like a 3 to 5% move in Nvidia. Anyway, point is, if mags are still strong, is that a barometer for you? Or are you focusing mostly, week to week on Bitcoin, kind of day to day to see where things go from futures to live market?
Yeah, Chris, great question. It's fascinating because you see there the eighth indicator is something I call the wave score.
Mm.
And that really is the what I call the chef's secret. And
Sorry, cat
is that bad luck to have a
cruising
black
by.
cat cross my path here? Okay, we got to
Your wave
sell
indicator
everything,
is
guys.
about to go off this chart.
That's awesome. I have four cats at home, and one of them is and he loves to come on camera. He's a Sphinx,
Oh
beautiful
yeah.
hairless cat. And I'm not a cat guy. It came with the girlfriend, but man, this I love this cat. I can't believe it. I'm just like I'm nuts over a Sphinx cat. Anyway, so the Mag 7 question will you know as a California surfer, dude, I went to UCLA and spent 10 years out on the beach in Southern California and just kind of equate that surf culture to what's going on in the markets, and that's where that wave score comes into play. And depending on the tapestry of what's going on, and you mentioned the Mag 7 divergence from the rest of
Mhm.
the market. I think it's more than 10. I calculated it. It was 12% of the S&P 500 on Friday was trading at 52-week lows.
Wow.
So there
That's
is quite
crazy,
a bit
man.
of divergence.
Yeah, a lot of divergence. I don't love that's been my concern with let me just throw this out there for you guys. So we have seen a pretty big disconnect from overall market breadth. If you look at the S5 FI is a indicator using the number of S&P stocks above the 50-day. We're down to 40.15. So we have about 60% of stocks in the S&P right now trading under the 50-day moving average. We're still clinging to 53% of stocks above a 200-day. So a lot are under the 50, but still holding barely, but holding above the 200-day. So I want to ask a question on market breadth. Is this a concern that this market is still sitting just off of all-time highs with market breadth not participating? Or is this just waiting for a little bit more certainty that everything is strong from the AI narrative, everything's strong from Mag 7 earnings, everything's strong from maybe this week we have another 700,000 stocks with earnings. Is market breadth waiting for another impulsive move to the upside to catch up with market breadth, or is this like it's all concentrated house of cards? We need to be prepared for a correction. I mean, it's November 3rd. Government shutdown is. I literally read this weekend. Don't expect the government back online until after Black Friday. So we might have another 15, 30 days of no government news, no data. Non-farm is supposed to be slotted for Friday. It's all tentative on the calendar. ADP is now, I think ADP is going to be printing job numbers every week as well as every month to kind of fill the gap. So at least there's some data sprinkled in, but all we have this week is ISM numbers, which came out today for manufacturing. I think we have services on Wednesday. Then we have ADP this week as well, but no non-farm to my knowledge until government's back online. But anyway, back to my question on market breadth. Is this the time to be concerned, or is this the time just to see like the market chop based on seasonality? November, December, historically, some of the most bullish months in the market. Do we just have chop? Do we have sideways? Does this market actually roll over with weaker market breadth? What do you guys think?
I'm going to jump in real quick because I know you guys need to get onto your presentation. So I wanted to share this because I think it's a good insight into how I think about things and what's going on behind the scenes with the market scorecard. We talked a little bit about the concept of surfing and looking for waves, and for the last couple of weeks, we've been really in a primordial stew that isn't that's fairly quiet. There haven't been really good waves to surf truly, and I do think you're right to point out the market breadth as being potentially a concern. But when I take a step back and look at everything, what I really honed in on this weekend is what I call the faux hawkishness from the Federal Reserve. And it's been my experience, dating back to graduate school, trading currencies in a laboratory setting. The lesson I learned there is unless a central bank is truly defending its currency, the parroting that goes on is something that you can hammer all day long. And right now, from Powell on Wednesday to the governors on Friday, talking about, well, you don't get your hopes up for a December rate cut. I think that's nonsensical, and I think that's where the beginnings. It doesn't guarantee the wave is going to appear, but a tradable move to the upside here for the next week or two could materialize as the bigger hedge funds attack that. You know, you may talk strong, but if you're not carrying the big stick to go with it, these big traders will hammer you. And I just think it screams risk on, and it screams breadth, not just the Mag 7.
Yeah. Well, also the probabilities didn't change a lot. We had like a 90+% probability for the October rate cut. It happens, 25 basis points. December it is now trading around a 65% probability. That's still well higher than a pause at 35%. So that tool, if you look at the CME group, which is the Fed Watch tool, that tool has not been incorrect since 2009. And that was with surprise move, I think, during Bernanke. That would have been Bernanke back in 09, I believe.
Yeah,
and that would have been a surprise. That would have been a surprise, Fed move like in the final minutes of whatever day was FOMC. But since that point, it's almost like the Fed's forced transparency. It's you see a lot of market movements, prices in. So when I see a pretty big probability at 65%, I don't care how vocal is Powell going to be from now until December 10th. Probably not very. I think he said his piece. The market had intraday fluctuation, and you can see the power of like 0-day trading and 0-day stability because that market sold off aggressively on Wednesday. What were we down, by the way, for that particular day? Let me go back to my workspace here. So Wednesday,
it was down,
it was like
but it wasn't.
It was a 5-minute move. I mean, the market went down in 5 minutes. It was down about 0.7%. And then by the end of the day, it was pretty much right back where it started on that move. So down 0.7 and then gave, 80% of that sell off back by the close. And the market still finished positive for the week because we had such a large gap on Friday to Monday that the market still clung to a positive gain. It was pretty much a wash week from like start to finish, but the gap up over the weekend and even the Fed didn't really derail the market day to day. I thought daily trading last week was very, very straightforward. Like market makers did a pretty easy job keeping these relatively contained. Kane, you and I talked a lot about some butterfly strategies. I had some good ones last week. I actually got a couple of nice pins going last week.
Nice.
So it worked out pretty well. Anyway, but yeah, it's good thoughts there, JD. On the watch tool, like I said, probability is still 65%. They cut in December. I heard an interesting thought this weekend, and JD, feel free to stick around. You don't have to duck out or anything. We'll get your Telegram up again. We'll post it again. But I heard some interesting rumblings this weekend. I tend to, if I go to the gym over the weekends, I tend to just soak up like as many podcasts and macro stuff as I can versus listening to music. So I'll just listen to like 1.5 speed podcasts, kind of like I'm talking right now. But somebody was, I can't think of the name. The podcast was Market Huddle, couple, macro Canadian guys that have been at it for a long time. But they interviewed somebody that, was working with the Fed under the Greenspan era. And now he's just doing macro research. But he said something pretty interesting. I didn't think about this angle. I think if there's one administration that would completely pivot into something to appeal to voters, it would be this administration. So right now we pivot from we're going austerity, we're going to, drain the swamp, we're going to cut, balance the budgets, we're going to cut the deficits, blah, 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 to then we kind of make the bond market flinch, we pivot hard. Now it's grow, grow, grow. And if inflation, the Fed has pivoted now from an inflation focus to now a labor focus, which is why we're getting the cuts that we are at these all-time highs. But if we start to see inflation, and I wanted to ask you guys, what is a number that you think voters would care about? What is the number that the data would show is maybe what we care about? I mean, we're at last time we had CPI numbers was a 2.9 print. Is that correct? Up from a 2.7 to a 2.9, or I think headline was 3%, and it was expected to be a 3.1. What's a headline that the market actually cares about? What's a headline that all of a sudden CPI is 4% headline? Does that mean that voters actually care because we clearly see like increasing inflation? And I'm asking because I think the Trump administration would pivot, even though they want a crazy dovish Fed. From the sounds of it, I think they would pivot into like, you know what, we need to handle this inflation problem, and they would pivot into Fed doesn't cut, let's tackle inflation, let's try to stabilize the labor market. I don't know. I just feel like they will appeal to keep voters, come, I'd say midterms 2026. So I know that's a bit of a long-winded question.
If I can jump in, that's a fascinating comment, and my own personal opinion on it is politicians, whatever their stripes, want to hand out candy, and fighting inflation. You're not handing out candy; you're delivering pain,
Right.
and I find it very unlikely that if inflation were to rear its ugly head, um, I just don't see the administration changing its tune, saying we need to fight inflation.
So you think so? To get to what point though? So we don't fight
Well,
inflation, and then what's the
I think
backup plan?
what the administration will do is they'll downplay, they'll call it temporary,
Right.
transitory. It's
Yep.
transitory. They may even say, this is just kind of what happens to reshore things, but it's temporary. You had a $5 trillion extension, for the spending in Washington, part of the big beautiful bill. They want to grow. They want to grow their. In fact, Bessent was out this weekend talking about, you know, uh, debt deficit to GDP falling, right? And they want to grow their way out of the national debt problem. and
Yeah.
I and I
38
and
trillion.
maybe and so you already have uh, the Federal Reserve. I think they're fine with 3% inflation. They're just not telling you about it.
Correct. I agree. I think that they won't tell us that, target inflation is truly a range. I think they're accepting a 2 to 4% range. They won't say that because they'll just keep saying the same thing. Target inflation 2%. But they've clearly tolerated it, and obviously they wouldn't be cutting rates if they thought inflation was continuing to be a problem.
And last week they were hawkish in their statements, but look at their actions. They were dovish in their actions.
Correct.
They cut
Yeah.
rates, and more importantly, the balance sheet discussion, which I know folks talked about it, but don't underestimate the power of a $6 trillion Federal Reserve balance sheet.
Yeah.
I mean, it's just to me, it's so basic that it's not a bubble, but it's inflation. The air is filling up, and prices are going higher, and that includes stock prices.
Yeah. Kane, any thoughts? I guess I'm just curious, like, so JD says the administration won't pivot. I'm just open-minded where I'm just like, yeah, I could see that. I could see if anything you got to take into Trump's comments is he will say whatever he wants to say and then figure out how to spin it however he wants to spin it. So that's a really tough path to know going forward. But I do think that the votes would matter. I know right now I don't know. I have no idea. And politics are my least favorite thing. And nobody has actually labeled me as like, Chris, you're really political. Because if you listen to me, I'm just annoyed by all politics, and I'm really a centrist, and I just want to trade the markets. But I've never seen the markets be so tied to the political agendas and headlines and narratives where, I can show you a chart of this year's Trump tweets to the VIX up and down, to the S&P up and down, and it's literally we have one guy that can say one thing and the markets react, and that's a lot of power to give one person. And it's interesting how markets are really sensitive, but they've also, we've come out with the taco trade this year. Anyway, Kane, thoughts on let's say inflation is up to 3.5 headline or 4% headline. Does this become a sticking point by people just exhausted. Yes, assets can be higher, JD, but not everyone participates in the stock market, unfortunately. I know you can have a 401k, but like that's money you can't see until you're, 59 and a half. So, I mean, I hope people aren't having to tap into home equity or having to tap into 401ks for hardships because they can't afford to just maintain a standard of living. I don't know. I think what this
Well,
ultimately leads me to believe is we have a Main
I'll
Street
let
recession
Kane
on the
answer your
way.
question, but look, I mean, the reality is, this economy is driven by AI spending, and it's
Yeah,
driven by high income spending. But yeah, the lower and middle classes, are being tempted by socialists like Mondami
for
in New
sure.
York, and that's tragic. I mean, in my opinion, I agree with you. I'm not, I can't stand politicians.
Right.
It's gross on both sides.
Yeah, it's equally as bad. And honestly, this is what, to me, what I mean, we all have these platforms here, but to have this discussion and see like there's probably some people that are tuning in and thinking, this is leaning one way and I'm getting uncomfortable. We're talking politics. Like it's become as sensitive as religion to a lot of people. It's divided families, let alone, strangers, which I think is crazy.
But you
But
have to be,
swinging,
as a trader, don't you have to be in tune with what's going on?
of
I mean,
course, but I'm saying like to swing, I mean, to go like either right or left, it's like either way, if you look back in history, regardless of what party's in power, regardless of who our president is, regardless of, Congress as split and lame duck president, or there's a majority, they all spend money.
yeah,
Democrats and Republicans all spend money, and
big
we've just
time.
continued to see like the deficits climb, debt ceiling doesn't exist anymore. We will raise it all the time. The bipartisan support you will get is military spending and probably raising the debt ceiling for right now. So anyway, Kane, we'll circle back for the 5 minute rant. But what's your thoughts on, do we pivot? Do we pivot on inflation? Do we not? Are we just going to be told, like JD said, we'll just suppress the data, we'll downplay the inflation, say it's a one-time thing, or maybe we offer like state of emergencies for the people that need it, and then assets continue to climb, and the haves continue to have, and maybe there's some social programs helping the have-nots.
Yeah, I don't think the headline print is going to matter as much. It's going to be what people really actually feel. So if you start to see it at the gas station, at the grocery
Mhm.
store, or at, mortgage rates, things like this, that's when they're really going to start to care. So I agree that this administration especially is very reactive, and they want to be seen a certain way. But Trump this year, he's done some pretty unpopular stuff, and he's stuck to his guns. So
Yeah.
and I think that's why the market has been more sensitive and more reactive. Also, we're talking a lot of macro stuff here, and does it actually show up in the markets? And that so far, the markets have been very reactive to, at the very least, to Trump, if probably not anyone else. But so I would say that if it actually comes in the form of a tweet from Trump, yeah. And I thought that it would have worn off by now. Because if you saw his first administration, it was the same thing. And for the
Mhm.
first 6 months, 8 months, maybe all the way up to a year, yeah, the market was highly reactive, and then everyone sort of forgot about him. And now we're pushing a year, and we're still pretty sensitive to exactly what he's saying. But there's two thoughts there. One, why? Because we haven't really seen that in the past. Well, we haven't really had a president other than Donald Trump himself really be
Mhm.
on social media and tweet like at any moment in time. They used to just go to a press release or something like that,
Right.
and Trump can literally just have his phone and at any second just throw something out there. But two, also we're probably starting to see a younger generation of people at funds who are in control of large pockets of money. I just met with I think he's 28, either 26 or 28-year-old over in Chicago, and he has his own crypto fund, and he started when he was 19. He's been in the markets for, call it, 7 to 9 years, and he's doing really well, and he's controlling large amounts of capital. But a guy like that, well, he's dealing specifically in the crypto space. He's seen nothing but a bull run. He
Right.
hasn't seen the full phase and full market. So I am a little concerned that the younger. So when I started, obviously I was young also, and I was around that age or a little bit younger when I was handling massive amounts of capital. But the difference is I started my career in the middle of, like, soon after my career was the housing crisis.
Hmm.
And so I had that at the very beginning of my career versus 10 or 15 years into my career. And so I always have that as my foundation of, oh, this is what I need to look out for. And the kids or the younger guys who are managing funds right now, they don't have that. And so I am a little bit concerned about that. And also the younger generation is more news sensitive
Hmm.
and reactive rather than like, look, you know, just because the news is saying this doesn't mean that money and capital is moving this way.
Right.
Although in their hands, maybe it is, but the larger institutions and the slower money, the retirement money isn't necessarily moving in that direction.
Yeah. Some pretty good comments here. Sam mentioned the AI boom is just starting. I think the narrative is still pretty fresh. You know, we're 3 years into a bull market. You have to remember, I was just talking to a team member before we got on this Gamma report. The average bull market lasts about 4 years. The average bear market lasts about 1 year. If you consider 2022, which was a pretty healthy 9 to 10 month correction, you know, S&P and Nasdaq were down respectively like 25 to 35% from peak to trough. That was a 10-month, like what felt like a bear market. Average bear market's about a year. And then since the bottom, which was around Q4 2022, we really haven't stopped going up. So you've got the very end of the year in 2022, pretty much all of 2023, and 2024 had a couple hiccups along the way. We had a pullback in April. We had a pullback in July to August. We had a little stall in December. 2025, we obviously rolled over aggressively February to April. We've melted up ever since. We had pullbacks July to August, pullback in September, pullback in October. October 10th was the day that sticks out. Didn't even offer a dip to buy unless you want to buy it on Friday. One thing that I think is becoming more and more apparent, I've got the screenshot from one of the sessions I listened to this weekend. We talk about this a lot. This I was asking JD if you do a lot of 0-day, because right now, I've got a screenshot right here that funds too. I mean, Kane, I mean, you were in the space. What is your thoughts on like a typical rotation cycle in funds? I mean, I know that I've seen mostly like we're doing a lot of. I mean, when I was with a fund I was with, I mean, we were doing some pretty aggressive rotations like every month. Like we'd revisit all positions. If we were up in profits, we'd scale it back. We'd trim positions. We'd sell more options or whatever it took to like kind of revisit core positions. I
Yeah.
specifically ran an arm that was only 0 to 4-day. So I was trading like index related hedging, and this was, you know, from 2022. It's like since I know 0DT's technically been around, like options were created in 1973. So we've had 0DT every Friday since 1973. But now that it's every single day in the index, I've taken thousands and thousands of trades since 2022 when you can trade this stuff every single day. I've been impressed with the amount of stability that 0DT has brought to the market. What I thought was interesting is average daily volumes in the CBOE with S&P 500 options. It continues to grow. Where right now 0-day it's like 55 to 60% of all option volume is 0DT, and we've had as much as 70+%. The sell off on October 10th, there was basically zero DT. There's no floor. There's one thing, Kane, I'll talk about this more offline, but there's something I'm considering where it's an aggregate feed that gets you like 0 DTE volume like in the moment, and you can kind of see like this 0 DT pressure that comes in each and every day. I know with your Gamma trading terminal and the stuff that I've used for my 0 DT levels, you can see like stability in the markets. When that sell-off happened on October 10th, there was no floor. And it was just one of those weird days where it's like from high to low, that candle was down 3%. The day itself was like 2.6 or 2.7. But then what do we do the next Monday? We gapped up aggressively. So like they kicked in on Sunday futures, Monday's open, and the market completely stabilized. We tested that low on Tuesday, but never broke it. And here we are, like back up again to all-time highs. So until 0 DT becomes either something that's a head fake, or all of a sudden people are just like get into crazy amounts of negative gamma where the market just cascades to the downside, I just think there's a lot of stability and liquidity like every single day. And you don't have to take unnecessary risk when you can actually, hedge every day if you needed to. You can take like little cheap cost effective hedges every single day, win or lose the day. It's like if it's a hedge that doesn't pay, fine. The whole portfolio is pretty stable. If it's a hedge that does pay, I mean, you can take hedges. I mean, Kane, you know this, like a hedge on a 0 day that pays you, you can get 10 to 1. You can get 20 to 1 in a 0 day. So the ability to take a very small risk and generate, a nice, steady, like kind of bulletproof return if you need it, is making the markets like pretty efficient. So I think that the 0DT stuff and the overall like rise in options since 2020, especially, we're at record levels, and every monthly expiration is a major milestone, and it's breaking new like nominal expiration dollar amounts, and expiration for November, whatever, 19th or 21st is going to be probably in the trillions of dollars at expiration. It's like this every single month. So anyway,
Chris, let me jump in real quick, because
Yeah.
you've struck a couple chords that trigger a little bit of my origin story. The fascinating thing to me, listening to you talk about 0 day, is a couple things. First, it's really, really hard for a traditional long-term investor, quote unquote, the little guy today. In my opinion, the market is requiring that investor to take on maximum risk for minimal reward. And that just does not make sense. And when you hear stats like from the Federal Reserve that, I don't know, 20 to 25% of individuals aged 50 and older, have zero saved for retirement.
Mm-hmm.
And we talked about the class separations and all of that kind of stuff.
Yep.
The 0 day opens the door for those folks to at least try to get on a level footing, and without having to take that maximum risk, with minimal return that an traditional equity individual, long-term investor is being asked to take today. The second thing, real quick, and this will be my final comment, on 0 day, and this is what I'm trading exclusively, except for today. We did the Friday expiration, with utilizing this market scorecard in what we're calling the opening bell arbitrage, using the 0 day securities to capture gains and exploit the volatility in the market on a daily basis. An interesting, factoid for folks to just stew on or think about, chew on, if you will. The average annualized return for an equity index, per annum, let's say, is 8% historically. Okay. Well, if you figure that there are 250 trading days in a year, 250 trading days divided by 8% is basically 3 basis points of gains each day the market is open. And we all know that the daily volatility in the market is, call it 50 bips, plus or minus 50 bips, maybe in some cases a whole heck of a lot more. So if you have a tool, which is what this market scorecard is trying to offer for folks, that gives you an idea of what that direction is, and then layer on top of it a 0 day option trade that, to your point, allows you to use a small amount of capital, with the potential, again, if your tool is reliable and you can consistently trade this way, you are, there's some 17,000 basis points to exploit in the market, that deviates from what a historical average return is. I mean, it's a no-brainer to me.
Yeah. I'll ask you, some of your let's give us, so you're talking the 8% annual returns, and that's also coming with about a 15 to 20% drawdown at any given point. Usually that's kind of the norm. Is risk adjusted returns, you're averaging about 8 to 10%. Your risk is going to be somewhere between 13 to 20%. Every year we have at least a 1% pullback. I think those numbers go down as the pullbacks get deeper, so 5 and 10 and 15 to 20, but 20% corrections happen every. I mean, we've had seven 20% corrections in the last 10 years. You go back to 2015, 16, a decade worth, you've had at least 20% corrections. Yes, they've all proven to be like you buy the dip, and it's done pretty well. I've been trying to stress this the last couple of weeks is, regardless of what happens, I mean, all the opportunities that JD's talking about for like 0-day trading, you don't have to risk everything. You can risk like a fraction of your account and just trade, less than 1%, less than 1%, but you get lots and lots of reps to trade and be right and give yourself an opportunity. I talk a lot about pot odds. 55% of the time, the market's going to be bullish week to week. 80% of the time over the last century, the market's been bullish year to year. Like, those are pretty good pot odds to just play the game and survive, knowing that, like, don't get trashed to the downside. And this market likely lets you pick up a lot of liquidity near some correction levels. If we have another 5% correction by the end of the year, or we have another 10, 20% correction by the end of the year, even if we have, heaven forbid, a 30, 40, 50% correction. I mean, I don't think in our careers we're going to go on forever, like up and up and up. It's like, we're going to have some volatility, and we'll probably see another 20% correction. We'll probably see a nasty fourth turning, chaotic reset. But if we have enough cash and dry powder to survive down to the lows, I mean, if you have liquidity near the bottoms of anything, you have a lot of upside potential. And I think that's where you look at, the income disparities over the last 25 years. A lot of it's come with having the ability to buy lows in these markets, because we have financialized our
Let me ask you a real
here.
quick question. I'm just curious because I don't necessarily know the answer. I have an anecdotal opinion on it.
Okay.
But those drawdowns that you're talking about,
Mm-hmm.
how often are those drawdowns out of the blue intraday? Meaning, most
Never.
of those
I mean,
drawdowns you can identify, they occur, or they begin formulating big time in pre-market, do they not, or overnight?
yeah. I mean, I think if you take 2025 as a sample, 2025, you were sensing a lot of volatility, and the VIX elevates, goes up to, I mean, our VIX was what in April? What was up to,
It
like
got over
55 or
50.
60?
Yeah,
So over 50
yeah.
VIX. We went very quickly from teens to 20 something, and then 20 something when vol suppression kind of ceases, and you go from 20 to 30. But day to day, it's like, I mean, the markets had, gaps lower of 3 to 4%. We had intraday swings of 2, 3, 4%. Volatility is super, super wide. What is crazy is, 0-day. I mean, I traded the market both directions in a 0-day during March and April, and still came out on the winning side with like 91% winners on like daily profit play. So,
That's
I mean,
awesome.
when volatility is wide, it actually is still allowing market makers to do their job, and they still have to do their job. But to your point, I mean, that's one thing I do like about 0DT is you can survive. It's like, I think here's one thing I want everyone to be clear of. Like, 0-day trading, gamma risk wise, is about 10 times the juice. So you have like 10 times the risk, you have 10 times the reward in a 0-day environment. And you can look at it both ways. I mean, I tend to look at it from the risk side, which is, understand there's a lot more risk because it's a binary trade that has virtually no backup plan. If I'm going to lose a 0-day trade, I pretty much lose it. I don't try to roll it. I don't try to dig myself out of a hole. I just accept that it didn't work. But if I win, I try to win more than I lose and pack away some profits. But nobody should be blowing up their account in a 0-day trade, day to day. Market makers have been doing this stuff for 50 plus years. They will have to continue to do it. And I think that's a good team to join. So I still like to, sell premium.
Here's another fact to it, just in
Yeah.
preparation for launching the opening bell arbitrage product, which we are launching next week, utilizing this market scorecard concept of identifying arbitrage opportunities. We've been tracking trades for the last 3 months or more, and finding the average range on the low end is right around 10%. On the high end, it's 15%. per day, right? That's your gain. So having a plan, to your point, you don't want to, put your entire portfolio into this stuff, but whatever your dollar amount is, $1,000, $100, $5,000, be consistent with, what you're putting into your trade. And boy, I mean, if you're putting $5,000 in per trade in a 0 day and generating 10% on average, and you do that over the course of 4 years, you're going to build $1 million portfolio.
Yeah.
Period.
And on that note, zero DT, somebody asked earlier about pattern day trading. Kane and I have talked about this on the show, but I am pretty sure that by 2026, maybe Q1, that pattern day trading is going to be removed as an SEC restriction. So I think that, and I know right now, if you trade Forex, there's no pattern day trading. You trade futures, there's no pattern day trading. But in stocks and options, you can get 3 trades a week. If that goes away, I do think that is another boost in daily option volume, and I think that is a big win for the retail trader.
Absolutely.
I mean, I feel like that's a big win for the retail crowd. I think it's silly that if you have a $5,000 or $10,000 account with an instrument that over the long run has proven to go up, and yet people, you let them opened up a sports betting book and gamble on a low odd parlay to try to make a 2x return or 5x return, and they can do that all they want every single day, every single night, but you won't let them trade more than 3 times a week on something I think is research-based, mechanical, systematic. So I'm hoping that's a big win. I think that's going to continue to see the numbers we've seen in option flows, which is it's a big part of where prices are going between futures and options. I think that's what's really driving price action.
It's
let's
get an
Kane's
awesome comment. I'm just gonna I have to comment on it because it's so good, Chris. You're spot on. If that goes away, I mean, citizens don't realize, government may be well intentioned, but a lot of times what it's doing is keeping the haves and the have-nots. It's keeping them apart. And actually that gap is getting wider and wider because of those kinds of policies. It's nonsensical that a small investor just trying to, that investor cannot build wealth with that kind of a label on it, if you will. So I
Sure.
hope that goes away.
I think everyone should
Nice.
have whatever permissions they want. Kane, what do you think, man?
On the flip side, so on the just play devil's advocate, I think it's absolutely a great thing and I'm all for it. But just to play devil's advocate, I think more people blow up their accounts.
Of course. Of course. Naturally, they will. They will.
Yeah. And so you'll see a higher number of blown up accounts, but on net, it's a good thing for everyone and for the markets. It's just that the people who come in, then they need to learn the risk management aspect
Agreed.
of it, which most people don't really. So on that note, I have a question for you guys. So let's just say you normally put in 5,000. That is your risk, and you're making your 10%, right? So you're 5,000, you're making $500 on your 5,000, and that's your normal allocation amount. You see VIX go wild, or maybe not even VIX. At the very least, you see realized volatility shoot up through the roof, and suddenly the opportunities that you're seeing are the 1 for 10 type of things that Chris was talking about that are common inside of zero DT. So my question to you guys is, are you still putting in? Because a lot of us do, and we do preach the same amount in every trade, same amount in every trade, same amount in every trade. But in that environment, that sudden change in volatility, are you still putting in 5,000 and maybe say, oh, well, instead of 500, I can make 5,000 off of my 5,000? Or are you saying, hey, let me put in my 500 and maybe I'll make 500 off of my 500. So I'll still make the same amount and risk less, or am I putting in the same amount into the trade and making way more?
I mean, my strategy is definitely more risk averse. I mean, I've always been a trader that for years, like I'm a base hit guy. I would rather survive the markets at every trade I take is always less than 1%, fractions of 1%, knowing that I can take thousands and thousands of trades and no one trade is going to be the reason that I'm here today or gone today, or, like I'm not going to blow up an account. I'm not going to, YOLO, look at this. Here's my Ferrari that I bought with this trade. It's like, that's never my style, man. Like it's just a trade. And I've spent a lot of time over the years trying to make my winners
That
and
stuff's
losers
only
feel
on
about the
TV,
same.
right?
Yeah. Well, I mean, unfortunately, it's everywhere. I'm just, but look, everyone knows this, right? If it looks too good to be true, it probably is. So there's a truth to what you risk. It's like if you want to take $500, make $500, there's a lot of risk that comes to that. If you want to take $500 and make $50, you can scale that and survive and take more trades and take more systematic trades. And I like to trade distributions and law of large numbers. If I'm going to take 100 trades, I should win as my edge. If I'm going to take 1,000 trades, I should win as my edge. Outliers happen. Outliers with defined risk, you survive and you go trade another trade. Same thing as if you think about the casino. I mean, American casinos are built at like a 56 to 58% house odds. Why would anybody sit at a casino table doing any game that if you play long enough, you're destined to lose? But in the markets, that has odds of 55%. If you play long enough, you should win.
Free
So, and
cocktails. That's the
so,
answer.
yeah. So to Kane's question, I mean, I'm a small risk guy. I know this, I mean, for me, it came back in currency trading. When I really cut my teeth in trading and risk management, it was, managing a currency fund, which in a Forex market, when I first started with 100-to-1 leverage, and he actually ran some lines of credit for some international clients that 200-to-1 leverage. I literally traded with almost zero leverage. Like I would be trading 6-figure accounts and trading for like micro lots. And they would be, 10 cents a pip that I'd build up to 50 cents or $1 pip. And I would scale into standard lots. And, I'd have 5 and 10% drawdowns here and there that on the upside I could turn into 15 to 20% gains, but it would take me months to build those positions. And I just did it very boring. And it's for me, it was how I could sleep at night in a 24-hour market. Forex is 5.5 days a week, 24 hours. It was stressful to be up every day at 2 a.m, Eastern time to trade the London market and notice that there's high volatility and fluctuation. So I just scaled back the risk and tried to never let the market. And I've had some scares, but if you have a scare where it's like, holy crap, one more push above or below my level, one more blow through my stop loss, I would lose everything. You have a couple close calls like that in your trading career, you'll stop doing that. So what Kane said is more people blow up their accounts. It's true. But what probably will happen is if people will, I don't want anybody to blow up their account. That's not like a rite of passage or a badge of courage. It's like, I would like to prevent that from ever happening to anybody. But it comes with the most like non-sexy, unglamorous way to do it, which is never trade too big and just stick to a process that can make you money safely. And I think you'll be better off for it in the long run. But I think we're also built on this like instant gratification. It's nice to know that I can take a trade today and I could potentially, double and triple my money. It's like, I get it, but what are the odds? What are the probabilities of doing that? So I'm a small risk guy. That's my answer, Kane.
It's a fascinating discussion. I think it was 2015, 2016 was the guru on a newsletter called The Millionaire Blueprint. And that title stuck with me, and I think a lot about the individual investor, the small investor that wants to build a large portfolio, but doesn't maybe have a lot of time. And I there's a lot of different ways to look at risk, and what at least from my perspective, what I'm trying to do with the opening bell arbitrage is, again, whatever your dollar amount is, it can be $100. That's the beauty thing about 0-day options is you really can allocate a small dollar amount. Now, the amount of time that it takes you to build $1 million portfolio is going to be much longer, but set your allocations and stick to it. The 0-day options that we're trading, we're going to take, if the direction of the forecast is wrong, and it will be wrong from time to time, that trade's gonna blow up. There's no doubt. That 10% average is just that. There are big losers. Would love to avoid those. It just doesn't, that's not realistic to think you're going to have a strategy that can deliver every single trade is a winner. That's fantasy. But if you, again, you can build up to that $5,000 per trade allocation, Kane, to your point. If volatility spikes, I'm actually licking my chops. I mean, that's when there to me, that's when there's going to be a lot of arbitrage opportunities. And my indicators tend to see a lot more clearly just from experience than maybe what the panic in the street is doing. So I
So
see
you're
it as
going
an
in
opportunity.
same consistent size when you see volatility. So yeah, I agree. Volatility is opportunity, right? That you cannot. Why is Bitcoin a thing? Why did it perform so well? Why is it continue? Why are we building Bitcoin treasuries around it? It's because of the volatility. If there's no
Mhm.
volatility, there's no opportunity for anyone. But if you see a sudden change in volatility, so you're saying, hey, I'm going to put the same amount of money and go after a larger gain, or are you going after the same gain? So 10% on my 5,000 is normally 500, and I'm making that consistently at a known rate across almost every single trading day. If you average it out, right, I'm making roughly 10% on average, and suddenly I have a huge change in volatility, and that 10% represents $500 a day for me. Am I on this day of huge volatility? Am I trying to make my same single 500, or am I trying to go for a home run and make
I
like
see what you, yeah,
5,000? Yeah.
that's smart. I mean, and that's a great point. It's a nuance that yeah, the inexperienced may not see that, so that's a great point. You you the volatility opens the door to opportunity, and then also there are larger swings, which then implies that maybe I can risk less. Personally, I tend to, I try to avoid making that decision, simply because and maybe this is the OCD in me, I just want to stay consistent with. I
Yeah.
mean, I know what you say makes a ton of sense, but I'd be afraid that, by the way, when I get the forecast right and I see an arbitrage and I can place a trade, with the 0 day, I mean, I'm looking at 25 to 75% gains on that day.
Mhm.
And then when I lose, I can lose 90%. And so, but blended together is where you get the 10%. So within each day, there's going to be a lot of volatility. And yeah, do I step away and then say, okay, today is, God, there's this volatility spike, and maybe I can, instead of 5,000, I can do 500, get a quick 100%. Yeah, you could do that. I can't argue with that.
So here's what that told me. So for the audience, the reason I asked the question is actually, for me, it depends on the system. And so the way you answered the question tells me about your system. So if so a lot of times in a lot of systems, volatility will destroy your edge. It will destroy your system because it's operating out of the normal parameters of your system. But what JD is saying is that his system actually acts on arbitrage. And when you have a large volatility, actually your chances of an arbitrage increases because the efficiency of the market to its ability to efficiently price and appraise things is a lot more difficult because everything's moving so fast and so big. So since he's operating specifically on arbitrage, well, then it might make sense to just keep the same allocation and you'll just win even bigger because now my edge is actually even stronger if I actually have more arbitrage opportunity.
Yeah, that's
Yeah,
great.
good summary.
What's the so JD, on this upcoming service, what are some of the like reward to risks? Is it defined risk? I'm guessing that it is. What kind, can you give us some parameters on like some of the size of winners, size of losses, how it compares, win
Yeah, I
rates,
mean,
things like that?
it is volatile within
Yeah.
each trade. You can lose 100% on 0 day if
Mhm.
your direction is wrong. We are doing the debit spreads, usually with a $1 spread between strikes on the put or call side. And within that, we can have a gain as high as 80. It's sometimes, to Kane's point, if there's that volatility and there's some sort of the algorithms trade on a specific event typically. Whereas what I'm doing with my scorecard is more multi-dimensional. It doesn't always capture that one-off event that the algorithms will hammer. So when that happens, and you can get a big, if I'm suggesting a 25 basis point up day, and that event pushes stocks down 50 bips, for example, then I might be able to get into that dollar spread for 25 cents if that happens.
Right.
And then all of a sudden now I'm looking at, when that event dissipates and then we're back to the blended multidimensional and people regain their senses and now we're back to 25 bips to the upside, I that trade just made potentially 125%.
Right.
Yeah. Is it index? Is
It is
on
an index.
Yeah.
Yep. Yep.
Okay, so one cool thing about the indices is that they're generally very liquid, and so you don't have a huge bid-ask spread. But if the volatility does expand, you'll actually see a little bit more of a bid-ask spread. If it goes wild, you might actually see like some 5, 10 cents, which is something that would be unheard of on a normal day. And you get to work, you get to be a real trader. You get to work the bid a little bit, right? You get to
yeah.
work that spread a little bit. So and the beautiful thing about that is like, oh, well, if bid-ask spread goes really big, especially on a spread, it might not be liquid enough for me to exit. Well, you're doing zero DT. You don't care how you're holding it. So, and if you're saying, hey, I'm willing to take that 100% risk anyways, and then you start working that bid-ask spread, then suddenly that increases your profit potential as well.
Right. Well said.
Really good. JD, when does this officially launch?
We're launching on Monday, I believe, or
Monday.
Sunday night, maybe. Maybe the first. I'm inundated with Zoom invites, so I don't have my
Sure.
calendar exactly straight. But
Okay. Best place for people to join you would be your Telegram, right? We shared that
yeah,
earlier. We might post that again. You can post it again. Deanna can post it again. But jump into JD's Telegram, and if
please.
it's officially going live Sunday or Monday, like I think there'll be a lot of fun. And also, we spent a lot of time on this. Zero DT's been this overwhelmingly positive phenomenon, I think, in the markets. I look at it from the efficiency standpoint. I think this is also giving everyone a chance to kind of find their way into the markets. I mean, I personally like having zero DT as it gives you a lot of reps. You will learn a lot about options in a 0-day environment, for better, for worse, but you'll see like literally a whole life cycle of a trade play out in one trading day, which is amazing.
Yep.
And if that's not for you, then you can obviously go out longer. You can go out a week. You can go out a month. It's like you always have the ability to see lots of reps, learn very quickly, and then you can figure out this isn't for me. This is for me. Some people absolutely love it, and some people crush it. Some people it's a little bit too high flying, too stressful. But again, that really comes down to risk and reward. I think that you can, for me, you risk small enough. It's trading can be kind of boring and you just stick to the numbers. If you win, you lose. How's it settle at the end of the day, the end of the week, the end of the month? Are you positive? You can trade all sorts of ways to make that happen. So I think it's a great way to learn. I think it's a great way to get your feet wet, trade some options, get a lot of reps. And then from there, figure out if you want to go bigger picture, maybe longer duration, but it's still the same trade. I mean, you can take the same amount of reward to risk profile in a 1 day or zero DT than you could if you were out 45 days. I mean, some of my core strategies that I used to take 45 and 60 days, I now trade zero DT because the mechanics still work. That's what's crazy. It's like, it's the same trade. It's just, wow, I can do it every single day versus I was doing it like, 12 times a year. Now I can do it every day.
Yeah, and you're making your 15% over a single day versus how many weeks? Yeah,
Exactly.
That's the same
Yep,
trade.
exactly.
Bill had a good question for zero DT options. Do you need a 25K account? Well, if you're trading indices and you're holding to expiration, they're all cash settled. So that exit trade won't count against, so it won't be a day trade. If you close it before the end of the session, or if you say, hey, let me get into it and let me close the trade before it expires, then it would become a day trade. Yeah.
Right. And again, the day trading would limit you to 3 trades a week on the margin account. 2 ways to work around this is, so I manage a few IRAs and they are cash accounts, but I have permission to trade whatever options I want. So if you have cash, You can trade as many times you want with a cash settled account as long as you have permissions to do so. And like we mentioned earlier, in a hopefully a little highlight for 2026 would be the SEC removes the pattern day trading restriction. So cash or margin, you can trade as much as you want, which I think will be a big win for the retail community. So it'll come with all the goods and the bads. Kane, you and I talked about before, this rise of like, take your 401ks and get some private equity exposure and get this commercial real estate and get this, blah, blah, blah. Like there's going to be pros and cons. I mean, we're going to be told that this was exclusive to Wall Street. Now it's open for the public. I have my reservations about that. But I mean, in order to let people trade as they want to trade with permissions they want to trade with, I'm a big believer that nobody should be told by their broker what you can and can't do. If you want to trade and rack up thousands of dollars in commissions because you're going to trade 10 times a day, do it. Because as long as you make money, who cares? But it's silly for a broker to be like, I'm sorry. It's silly for SEC to be like, I'm sorry. But like I said, you can jokingly like trade, ping pong and women's hockey and field hockey and soccer, and you can put all these bets together over a betting app that's like, what are the odds of you winning? And then with the NBA scandal, let's talk about that for a second. It's all fixed.
Hey, I'm going to cut you before you
no, it's okay.
Go off script. Really appreciate you guys having me. What a fascinating discussion. I could chat with you guys, and we should. I love talking about this stuff. So thank you so much for having me. And folks, follow me on the Telegram, and appreciate the opportunity. I think whatever your trading strategy is, what I will say is that the scorecard, everybody should have it as a tool, no matter what your strategy is. So right now we're giving that away for free in the Telegram, and you can just follow along at home just to see how it might fit into whatever your trading style is and what have you. You don't have to, get involved with the service. I obviously hope you do, but that scorecard is, I mean, it's pretty insightful, and again, even if you might disagree with it, it's all more information is always a good thing, in my opinion.
Yeah, especially if you're steering the way towards making good decisions with that information, versus just being shotgun to it, and it's a little overwhelming. So to make some sense of that scorecard, it's very clean, easy to follow. You're running a nice professional narrative with it the whole time, and it's just a trade. One trade is just a trade. I think everyone should be able to survive hundreds and hundreds and hundreds of trades before it's like, I don't really like this strategy. I think we need to give every strategy a fair shake, and trade lots and lots of reps, and then you can make a really informed decision, whether or not it's for you emotionally, whether it's for you financially. But give it a chance. I think that's I think all of us would agree, like, our least favorite student would be a shiny object student that comes in, dabbles, and then never sticks to any one thing because they're just looking for the next thing. Like, that's eventually going to make you never make a decision because you don't know what to do ever. So anyway,
I just hope it makes sense. So
yeah.
All right, I'm going to duck out, guys. Thank you.
Yeah.
Thank you very much for having me.
Thanks, JD. And you're welcome anytime, man.
Thanks, JD.
Thanks, guys. Bye-bye.
So just to finish my thought on what Chris just said is, if you're always popping around, the question is, why did you go to the next one? And it's because you thought this other thing would be better, or you were kind of sort of unhappy about the thing that you were just in. So whatever you quit, you probably quit a loser. You're just like, oh, I didn't make that much money on this thing.
Very
and
true.
So when you quit a loser. And that, so if you're hopping and hopping and hopping up, you're quitting as a loser, then you're losing all this money all on the way of hopping to the next thing. So you got to give the whatever you're in a chance to really like work out for the system to actually work through an entire cycle.
Mm-hmm.
Otherwise, you're either on an up curve or a down curve, and you don't get to see the whole thing.
Yeah, and that's it's not fun. I mean, there's that old image I remember, like kind of through the learning process, which is like it's just a cartoon of a guy like digging in the dirt, and he basically is like ready to walk away, and like right behind it is like his treasure, like the diamonds and stuff he's been digging for. It's like right there, like one dig away. and I feel like if you're
Yeah.
taking a strategy from Kane or strategy from JD or strategy from me or any of us here, I mean, the goal is we've done the research. We know what this trade should offer. We know what the edge is. I mean, look, I can't make investing any easier than understanding that if you're in it long enough, there's a lot of ways to make money. Even if you invested at the worst possible time, if I was 150 years old and I was able to trade from, the great financial or the great recession, the 1929 crash to now, you survive it. And it's never look, I mean, Kane, when the market eventually goes down another 10, 15, 20%, or we have another nasty bear market, whatever it is, whatever the catalyst is, it's not going to be pleasant. I can promise you that. There will be some winners. There will be lots of losers and casualties. There'll be a huge reset. But a lot of money is made near the bottoms. Doesn't have to be the bottom. I'm saying if you can just survive the way down it, you're going to be okay. So can I ask you for whether it's personal stash? I mean, are you always invested? Always invested? If you have 100% of your portfolio, are you always invested, or is there always kind of some dry powder for you?
Oh, there's always dry powder. You're never 100% allocated unless it's a very small account. Like if it's a $1,000 or $2,000 account, then maybe you get pretty close. Yeah.
Okay. Okay. What do you have right now? I'm just curious. I'm sitting on about 45% cash right now.
I'm at about 70% cash. No.
Okay. Let me actually do the math.
Yeah. The volatility for me is we're waiting for things to settle a little. But
yeah, I'm 52% cash right now.
Okay. Yeah.
Yeah. I got in. So even during the decline, February, March, April, I think I was down to about 35-40% cash at that time. So I've raised a little bit over the last, couple of months. I've been pretty, I've been cautious, but we didn't really get big picture here. Look, man, it's November 3rd.
Yeah.
I don't know what I'd be grasping for outlier wise or grasping for catalyst wise to see this market dump 10, 15, 20% by the end of the year. I think we can go sideways. I think we could have a lot of disappointing, non-direction, which for the people that have been rewarded by just being bullish and being directional, I feel like they would struggle in maybe the next 4 to 8 weeks if the market is sideways. I have one of my favorite strategies is waterfall income, and that's my strategy too. We're sitting on 10 open positions. Everyone's probably going to offer us a safe return of 98, 99%. We'll let them go to expiration. I don't even mind it because a lot of my trades are stacked up to November and December and early January. In fact, we took a trade today that expires December 26th. Did you know that there's a December 26th expiration in the calendar right now? I swear it just got added because I could have swore it went from the 19th to the 31st, but there's a December 26th expiration now on the SPX.
That's interesting. Okay. Yeah, I thought I knew 19th and
so the reason I took it is because I've been overlapping a lot of these trades, and I'm running out of I've done the 19th, a few times. I've done the 31st a few times.
31st.
So I found it today, and I'm like, huh. So we've got Christmas Eve on Wednesday, Christmas Day on Thursday. You mean to tell me there's going to be a lot of price action on Friday, the 26th? I would hope not. Maybe some random surprise, but even that is probably limited movement, I would say.
Yeah.
But don't you never know. Maybe a Black Monday on a Friday.
Right.
A 20 standard deviation move on the day after Christmas. No. Anyway, lots of ways to do it. So any final thoughts, any parting words for today? That was fun to have JD on. What are your takeaways from just a little bit of everything we talked about?
Yeah, I would say, be aware of your risk. And right now that there are a lot of things on the macro front. And for now, sometimes we do pay a lot of attention to those things, and sometimes you have to be like, okay, I need some of this is noise, and so be able to filter that out and just say, hey, I have positions. I'm going to concentrate on my positions and making sure that everything is still within my trading plan, and I don't have to be in another position. Every once in a while, I get these emails. I don't know if you do, Chris. We're like, "Hey, can we have more trades?" This week has been kind of slow. Can you give us more trades and more trades? And don't feel like you need to trade all the time.
Yeah,
The if you when we were managing professionally, the at least 90% of my time was spent managing the existing trades, not going into a new trade.
agree.
So
Yep.
retail, I feel like there's this drive, there's another trade and another trade and another trade, and it's like no, like just take care of the positions that you have. It was the thing. Who said it? Like the put all. I think it was Carnegie. Yeah, put all your eggs in one basket and then watch it very
That's a
closely.
Druckenmiller.
Or Drunkenmiller.
Yeah.
Okay. So yeah, just I mean, watch it close. Watch the things that you have, and
Yep.
then yeah, look for opportunity, but watch the things that you have,
Yeah.
and just watch your risk very carefully.
Yeah. Kane, I want to talk about this. So I am really thinking about doing this. I've been looking at just so I listen to some interesting content when I catch up over the weekends and stuff. I've got some pretty big bears out there. I've got some pretty big bulls out there. I'm trying to find my own opinion in the middle and just try to, figure out what's best and obviously manage risk. But one thing I thought was interesting is if I did expirations on IBIT, if I just bought shares of IBIT, let me share my screen here so we can talk about this for a few minutes. So IBIT, if I bought shares, which are trading around $60.54. So cash, let's just talk cash accounts. I'd spend $6,054 to buy 100 shares. Now, if I do that out to, let's just say December of 2026 on IBIT. So I go out to December of 2026, which I can go out here to June or I guess January 2027. It's fine. So it's about 14 months out. If I sell an at the money call, so if I buy the shares at 60.54, I sell an at the money call, I get 15.20 out of a 60.50 position.
Yep.
Okay. So right now, if that's all I did, I can basically put in a credit that helps me generate about a 25% return on IBIT as long as price stays above $60. And if you believe in the narrative of Bitcoin, you think that the assets will go higher, you give it until January 2027, which is obviously a huge unknown. But if Bitcoin goes to the moon, there's a good chance this thing gets called away, but you just generate 25% return on risk. That's not a bad trade. What I thought was
Not a bad
crazy
trade.
is look at this. Look at Tesla. I can go out to December of 2026 on Tesla. I can sell an at the money for 123.50. It's going to tie up, and granted, it's a more expensive stock. We'll say 468. So if I can make 12,300 out of a, let's say 468 investment. Oops, that's a fat finger trade. So 12,300 divided by 469, 26%. I get more juice in the premium of Tesla out for less time than I would in Bitcoin, which is kind of crazy to me. And
That is kind of crazy. Yeah.
I get it's volatile. I don't know. I mean, so obviously, if I took a trade like this, I'm going to hedge it. I'm going to chew into this a little bit, but I'm essentially looking at, my gosh, if I bought, $100,000 worth of Tesla and I could generate 20+% of that by just selling an at the money call. If Tesla goes to the moon next year, great. I get it called away and I generate 20+%. How would I hedge it? Probably a very inexpensive long put, probably a debit spread of some sort. And all I'd be focused on is lowering my cost basis. Obviously, if I lower my cost basis, this is what's kind of crazy, is I buy the shares at 469 and I take away 124. My break even on Tesla is 345.
Yep.
That's not a bad break even to start with. If we think Tesla can go up from here, if we think that, humanoids continues, I mean, to me, Tesla is an energy play in addition to humanoid robots, in addition to profit margins, in addition, it's way, way, way more than a car company. I wonder if it's going to be a really interesting player in 2026. But any thoughts on that? Like, that's a lot of premium, dude. And I just think thoughts wise, everyone that hates on Tesla because it's overvalued and the price of earnings is through the roof. Everyone that loves Tesla thinks it's a forever stock. And I don't know, I'm just thinking out loud.
Yeah, well, I mean, as long as it continues to see volume and some
Yeah.
level of volatility, then yeah. I mean, obviously, if you're getting that price versus a Bitcoin ETF, I mean,
Right.
there's some volatility baked in there, which is, like as you were saying, it's a little surprising that uh, that that implied volatility is higher than it is over in Bitcoin. So yeah, that looks juicy. That looks juicy.
Um, any do you have any like risks on Tesla? Do you think that Elon Musk would ever leave Tesla if he doesn't get his $1 trillion package?
I think he would.
Yeah,
I
I do
think he
too.
will.
I think that is like the one outlier that nobody knows, but it's like I could totally see him just leaving Tesla and saying, "Look, you guys
Yeah,
just make cars. I'm going to go do something else in private equity and build something to get us to the moon and build this, super energy efficient humanoid, blah blah blah. Not a single human worker, and it's all automation. I
yeah,
could totally see him doing that. But anyway, I think that's where the risk is like it's the unknown. But if I were to buy Tesla right now, I will say this: the one thing that I am optimistic about is I continue to read a lot of research on autonomous driving in Tesla and how good it is compared to Waymo. I think right now Texas is a hot spot for this, where there are more Waymo scheduled drivers or scheduled rides than there is Uber. Um, and they're saying within the next like 3 to 5 years, like 90+% of all drivers will be autonomous in certain areas that allow this and permit it. So, but as far as the autonomous driving goes, Tesla could be like the leader in that because it's basically like a self-learning autonomous vehicle versus whatever, like Waymo does one thing and Tesla does something very different. But from what I'm seeing in
yeah.
the AI space, that Tesla's like autonomous vehicles are it's light years ahead of Waymo right now.
I
So
believe it. I mean, they have a huge head start in terms of data collection. So they started way before anyone else. And
mhm.
I think sometime earlier this year, they signed with the Chinese government, which is crazy that the Chinese government allowed an American company to do it, but they're allowing the Tesla's autonomous driving and data collection on their streets.
Mhm.
So you got a massive amount of data now, like I mean, two huge land nations of cars just driving around collecting more and more data, more and more data. So I think they have a huge advantage. I believe when you say that they have a huge, well, they're way ahead because I think they have a huge advantage.
Yeah. This is just a kind of devil's advocate thought, but insurance premiums have gone up. I don't even know how much, dude, like hundreds of percent while we're
Yeah.
being told like, hey, healthcare is decreased. Like, according to the government, healthcare costs have gone down 18%. Show me somebody's insurance policy that's less.
Wow.
There's
Jeez.
no way. Like, that data is completely effed. And then on top of that, you look at the rising cost of like property insurance, car insurance. If we
Yeah.
get a big shift into autonomous driving, I do wonder what that looks like for an insurance company. I would hope that we have cheaper insurance premiums if it's like, look, I'm not even driving, I'm just a passenger. Whether
Yeah.
whether it's like a ride service, like if you're doing like, let's say it's Tesla vehicles in a city, but they're all autonomous driving. Are you like, you don't have to drive anymore? Like, take away your vehicle, no car payment, no car insurance payment. Like, I think
Right.
that'd be a good thing because right now that is so expensive, man. I think the average car, average insurance combo is probably well over $1,000 a month for most people today,
Yeah.
which is
Yeah. It's
crazy.
crazy.
So I'm hoping that's some big expense. I mean, right now I'm pretty sure that house and car are the two biggest fixed expenses for most households. So
Yeah.
I'd love to
And
see a dent in one of those, and I think it'd be nice to drive less. And if it's autonomous vehicle that's supposed to be safer, I hope it is. There's going to be, the one story that's like, hey, my autonomous vehicle got a car accident, and I don't know. I mean, that's the stuff, but we're also texting, driving, eating, reading. Like,
yep.
people are
Yep.
terrible drivers, man. So
And like 10, 15 years ago, I don't know exactly when the first Teslas hit the road, but when Elon Musk came out and said, "Hey, autonomous driving, robo taxis, and no one's going to need a car anymore," I was like, "Well, I don't know. Americans are really attached to their cars, and it's
yeah,
part of this big part of your like teenagers coming up, getting their own freedom, all of this. But now with the costs, like it might make
yeah,
sense. You're like, well, I don't want a car. I don't want if I can live in a society where I don't need a car, then which a lot of Europeans are like large urban uh urban uh centers, you don't need that vehicle. And so it seems to be that Musk might have been right about that one.
yeah. Well, I actually do know a fair amount of like probably the 16 to 26-year-old between like high school and college kids that I work with for a little golf stuff. It's like most of them don't have their driver's licenses. So it's not
Wow.
nearly as popular. Like, that was like our first step into adulthood, was like get in your car and be able to leave,
Yeah.
drive yourself to
Yeah.
practice, go to school, whatever you needed to do. But now it's like kids are in their 20s in college that still don't have a driver's license, don't have any intention to get one because they just walk on campus and don't need it. So
Yeah,
yeah.
that's
And
true.
plus if
Yeah.
it's that expensive, like it is a racket, man. I mean, I came out here to Utah and my car insurance doubled and I drive my car 1 day a week. Like, how does that make any sense? It doesn't make any sense to me. How I'm
Yeah.
spending double on insurance for a car that I drive once a week for a couple hours. So anyway, all right. So I'm debating because I might take a chunk in my portfolio. I've got some cash, and I think that's not a bad spot to do it. I'll obviously have some protection, but I thought what was cool is if I had a 26% premium, like I get it that I'm completely capping myself, and we might have this conversation, Chris. If you just bought the shares and never covered it, I get it. Like maybe Tesla goes from 470 to 1,000, and I miss out on that 100% upside. But I also realize that if Tesla goes nowhere and my break even's 345, that's a lot of premium
Yep.
that I can just continue to work with.
Yeah.
So I think it's a starting point. I just thought it was interesting that that actually had better premiums than Bitcoin, which is kind of nuts.
Yeah, super interesting. And to your point, to your strategy, the ones that are working the best for me, my trades that are working the best for me are basically neutral trades where I have eliminated the risk on one side or the other. So,
Yeah.
and usually to the downside because where we are in the markets right now.
Yeah.
And if they move upwards, I have some wiggle room before it goes against me.
Sure.
So,
Of your, so we talked about, you've got, you said about 70% cash, right?
yeah.
Okay. So of your allocated positions, how much do you like own as like a campaign trade where you like own shares, maybe prune with some options around it versus just doing straight up like option trades? What of that like 30% you have allocated, do you actually own some shares?
Not right now. Right now
Okay.
I'm looking very short term because
Gotcha.
I don't know. I think there could be a market turn at any moment in time, and so
Yeah.
I'm just waiting.
Interesting. Yeah. Market turn. I mean, I'm like, it's a, look, I'm right there with you. Like, I think that right now, just talk a little charts here. Could we roll over into like the 2150 day? I think we could. Could it get uglier and nastier? It could. Like, I think right now, the one thing that every good trader knows is that the left tail and the right tail are both as big. Agree
Yeah.
or disagree? You think it's all left tail, or you
Yeah.
think it could be both?
It's both. I
It's
think it's
both.
definitely both. Yeah.
Yeah. And what we mean by that is, so the odds of this market, if we have a correction, the odds of this market maybe going from what starts to be like a 2 to 3 correction can quickly become 5 to 10%, maybe more. And then the flip side of that is, the way that price behaved last week, Kane, having that like 2 to 3 day gap to the upside, I wasn't
Yeah.
super stoked to watch that. Like, I'm like, what is driving this right now? Market breadth is nowhere to be found. And we've got 60% of stocks down today. Like, why is this market up? And it obviously leveled off, but I'm like, is that the potential behavior? It's like into the end of the year, this like blow off top. And it's like, oh, volume's low. Nobody's really selling. Nothing's really crashing. The narrative's in check. Everything looks fine for the holiday season. And then we're off to, 7,000 plus with some drifts. But
Yeah.
to the same point, like a pullback, a pullback, a pullback, I don't know. I just think a plus or minus 10% is very doable. I think a plus or minus
Sure.
20% downside to maybe 5 to 10 upside may be doable. I think that there's certainly more risk to the downside right now, in my opinion. But we'll see, man. It's going to be an interesting way to finish out the year. I'm hoping that things just kind of stay the same, but I'm hedged as always. So,
Yeah.
what do you got going on this week, dude? What other, you got any master classes or training sessions this week?
I think we're going to get a trading terminal, GX trading terminal on the
Okay.
books, but I'll have to check with Deanna if we actually did.
Okay. All right. Well, if you do, everyone that's listening, like get involved. I do have a masterclass this week so I'm live every day for daily profit play. We just took a 95% winner today out of credit. It was a nice little standard daily profit play. Price behaved really nicely. We got filled where we wanted, held onto it. I ended up grabbing 95 cents out of the dollar. Double ups. I'm looking right now. We finish out in the next 32 minutes. I'm in the dead zone, which is not great, but I'm taking small risk. I'm going to lose maybe a max of like $200. So net, it's still positive on the day. Obviously I want to try to sneak out a winner. Prices sitting right around the midpoint and it's fine. Anyway, waterfall income,
Are those
great
are those
trades.
double calendars, or what are those
The
double ups?
double ups are going to be my butterfly. I do a lot of butterflies and iron butterflies and
Okay,
double ups.
gotcha,
So
gotcha.
last week, I told you last week we had a couple of we nailed a couple of pin trades. We had one for 520%. I had one that was
Nice.
over 220%. I had one that was the net winner. Fudge, what was my risk? I actually it wasn't a huge winner. It was like 100%. I was risking 775 and I made 650.
Okay.
So,
Yeah.
I mean, I was making I guess it's about an 80% return on that risk. But I had the market surrounded up, middle, and down. I went a little bit aggressive. I just cast like a big wide net where everything overlapped for like 120 points. And I usually don't do that, but it was one of those days where I got a pretty good read on my gamma levels. And I'm trying to think what the day was. It would have been it might have been Friday. Yeah, it would have been Friday. So I had I'm trying to think when I actually closed out the trade. So I closed out the trade in here for a net $100 across the board. So I had 3 trades. I closed out for $100. I always do this as I take these trades is I learn from every winner and I learn from every loser. And an example like this, when I had basically a net that looked like, okay, if the market gets back to the highs, there's a lot of money up here to be made in the middle and to the downside. So that's roughly what my, butterfly spreads look like, or my iron flies look like was these traps. So late in the day, the one spot price that was accurate, it was right here. And I can remember this because I talked about it on Friday. It was 3:56 p.m. And the trade that I was in for, I want to say it was in for 1775 credit, was trading down to $5.50 debit. So that is a $1,200 winner.
Nice.
The bottom side down here was risking about $110, and the upside was risking, actually, this was a 90-cent risk, and this was this was risking $200. Sorry. So $200 so 290 max risk on the other trades. Point is, you get $1,200 up here, and you take away the 290 of the other risk. You walk away with like $800 or $900 on the day. Now, did I do that? No, because at the end of the day, if this was unmanaged, this trade would have netted me about $650. If I managed it in those final few minutes, you're able to grab about $1,000. That's kind of one really cool thing is, we talked a lot about zero DT today with JD on. I know you and I both watch this quite a bit. These trades, in my opinion, have to be managed. It is amazingly sensitive at the end of the day. If you trade a butterfly spread, it is all or nothing. I mean, we've mentioned this in this show. When you start out your butterfly spread, the peak looks like this. That's the end of the day. If everything goes well and it's inside your profit trap, it's a massive potential reward. But the nice part is during the day, let's say this in yellow is my actual risk graph. But during the day, if price just floats towards the direction of your butterfly spreads, you actually increase the left side and the right side of your trade. And so you can still make a decent, I'm not going to say a huge return, but you can get 20%, 30%, 40% return on your risk in the middle of the day or early in the day and still have, plenty of time left. As the day continues, what happens is the left side gets a little bit tighter and the center goes up. So you get a little bit less on the left and a little bit higher in the center, something like that. And then as the day continues, as you get closer to the final like 30 minutes, it's more resembling like that type of trade. And at the very end, it matches the exact risk graph. So the net is wide early in the day. And Kane, I was going to ask you this. Do you have best practices where if you put an out of the money butterfly, if it hits your strikes, are you generally taking the profit there if it hits your strikes?
Oh yeah. Yeah.
Okay. I do the same thing. So I'm very happy with like, if this was hit and it's offering 20, 30% return, I'm going to take it because that was my plan for the day. Yeah. So, okay, cool. But I think that's a great way to, it's a really, again, we've said this before in the Gamma Report. It's a very low risk, high reward strategy. And I think that helps a lot of traders get the job done. We talked about, 0-day trading has 10 times the potential reward and risk. So if you take care of the risk part, just focus on managing winners. I mean, I love the fact that you can take winners that are, still have a higher probability. I mean, Kane, your butterfly strategies, you're winning like 80% of them. I'm a little bit less because I tend to go both sides. I win about 60% because I'll choose this side and this side and try to net a winner for the day. But if I just
Okay.
went one side, yeah, I would probably win 70, 80% as well. I don't mind going both directions with what I read, gamma wise on the day.
Sure. Yeah.
So cool stuff though.
And sometimes you can set those up where you go both sides, where even if it lands in the middle, you still make a small profit, right? So
Yep.
your risk is only on the outside. Yeah.
Or at the or minimum risk. Like, I mean, if I was like today, for example, I'm dead wrong. I'm down $200. Dead wrong. I'm literally like, I'm toast for the next 27 minutes unless price. Here's what's kind of cool is if somehow price gets away from the center, this is my kind of positive negative gamma pivot point around 68.50. If we somehow come down to like revisit 35 or 30, I want to see what that trade was originally this morning. Let me check. Let me go back to SPX. I think it was 20 wide this morning. I didn't go super risky here. I think I went 15 or 20 wide. Where's my fill? Okay, so yeah, it was 15 wide. So when that center price is 10. So from 10 to 25, I don't know, it's a tough call today. So 10 is down here. 25 is up here. So if we somehow revisited the end of the day, if we came down to this low, I might get a couple $100 profit trap there. Maybe. The reason I took the trade originally is I saw us falling. I thought this was a bit more expensive than I wanted to take the trade. So I put it down near these lows from Thursday and Friday. I should have just taken the profit there and not continued to trade through the day. If I'm, it's obviously what I learned today was this was a winner of about 42% right there. I should have just taken it. I still made, 95% on my daily profit play. That would have been a nice net gain. So the way the cash settles now is we'll see what happens. But if this gets bigger, 40 is not quite enough magic for me. I need this to probably get down below 25. If we come down to 25, somehow get to the low of the day, then we got a big fat profit trap waiting. But wishful thinking, it's probably not going to happen in 25 minutes, but you never know. And I just know that the risk is really small. So who knows?
The last 30, sometimes you get these wild runs. So.
Dude, the last 30 can be nuts, man. I mean, this was the final 5, 10, 15 minutes right here. There was a huge move that day. Final, I mean, this was a 20, 25 point move in the last 20 minutes. It moves fast, man. It's kind of crazy. And that's why it's kind of an all or nothing deal. Even during FOMC, we had the huge sell off in FOMC and the final 20, 30 minutes was just like more of a melt up from 52 up to 95. I mean, that was a 40-point move in the final 20, 30 minutes of the day. So crazy stuff. But when you have, highs and lows for the day, which I tend to do like very meticulously is try to find like safe probability highs and lows. You can trade a lot in between. If I think the market, won't necessarily go higher or lower, I spend a lot of time trying to figure out, okay, well, if it's not going to extreme highs or lows for the day, then let's figure out where I can trade and make some money, inside those ranges. So a lot of ways to kind of dissect it. So, all right, man, Gex Trade Terminal for you this week. If you get down the calendar, awesome. I have a pinch point scanner masterclass this weekend, Wednesday, in a trading session. We did a double up last week. We did waterfall today, daily profit play every single day. Videos went out last week for Project Options Edge. I also did a 2.5-hour workshop last week on practical options. So I was live quite a bit last week. That's what I do. So if you're, wanting to get some Gex Trade Terminal, jump in with Kane. You want to see some live sessions? I'm live every single day. You know where to find us. Appreciate everyone being here. I'm going to jump over, do a quick final hour segment on my YouTube channel, Kane.
Awesome.
Looking forward to seeing this again next week, dude.
Yep.
Hey, where are you, by the way? Are you back home?
I'm back home. Yeah, I got home last night. So.
Okay. New office, new background, new location?
No, I just I didn't go into the office this morning. I just out. Yeah.
Okay. You're not in the usual pit, huh?
That's right. Yeah, that's why you see cats running around.
Yeah, that's right. That's why. So JD has 4 cats, and then Roger mentions Clyde all the time. So I don't have a cat. I have a French bulldog that is hanging out on the. He just likes to barf and puke and fart all the time. So he's a disgusting creature, but he's fun. So yep, they make good trading partners.
Good. Yeah.
So all right, man. Have a good week for you and everybody else. Thanks for being here for the Gam Report.
Yep. Yeah, you too.